studying your last two. I swim with tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
When discussing salary and dividend planning, many beginners immediately focus on tax rates, corporate profits, and compensation calculations. However, experienced tax advisors start with a much simpler question. How much money does the client actually need to live? This is the foundation of all compensation planning. At the center of this slide, we see an owner-manager surrounded by the real expenses of everyday life: mortgage or rent payments, vehicle costs, groceries, family expenses, debt payments, education costs, healthcare, and even vacations all contribute to the amount of cash the client needs each year. These lifestyle expenses determine how much money must eventually come out of the corporation. On the left side of the slide, we see what beginners often focus on. They look at corporate profits, tax brackets, and tax rates. While these factors are important, they do not answer the most important question. A corporation may earn a large amount of money, but that alone does not tell us how much the owner needs to withdraw. On the right side of the slide, we see what professional advisors focus on. They examine lifestyle needs, family cash flow, and personal spending requirements. Their goal is to understand the client's actual financial reality before designing any compensation strategy. The process shown at the bottom of the slide summarizes this approach. First, determine the client's lifestyle needs. Then calculate the amount of cash required to support that lifestyle. Next, determine how much compensation must be taken from the corporation. Only after those steps are completed should you decide whether the money should be paid as salary, dividends, or a combination of both. This is a critical mindset shift. Compensation planning does not begin with tax calculations. It begins with understanding the client's cash needs. The key takeaway is simple. You cannot properly plan taxes until you know how much money the client actually needs. Once that number is clear, every other compensation decision becomes much easier and much more accurate. One of the biggest mindset shifts in owner-manager tax planning is understanding that corporate profit and personal cash needs are not the same thing. Many people assume that if a corporation earns more money, the owner automatically benefits more. But compensation planning is not determined by what the corporation earns. It is determined by how much money the owner actually needs to take out. Let's look at the two examples shown on this slide. On the left, we have client A. The corporation earns $200,000, and the owner withdraws the entire $200,000 to support their lifestyle. As a result, nothing remains inside the corporation. This creates several limitations. There are no retained earnings, little opportunity for tax deferral, and fewer long-term planning options. Even though the corporation earns a significant amount of money, most of the planning advantages of incorporation disappear because all of the cash leaves the company. Now look at client B on the right side. This corporation earns $100,000, but the owner only needs $50,000 for personal living expenses. The remaining $50,000 stays inside the corporation. This creates a completely different planning environment. The retained earnings can support future investments, retirement planning, business expansion, holding company strategies, and other long-term opportunities. The corporation becomes a platform for future planning instead of simply acting as a pass-through for personal spending. This is why the statement in the center of the slide is so important. What matters is not what the company earns. What matters is what leaves the company. The money that stays inside the corporation creates flexibility and planning opportunities. The money that leaves the corporation becomes personal consumption, and is no longer available for future corporate strategies. The key lesson is simple. Lifestyle needs determine how much money must be withdrawn. Those withdrawal requirements ultimately determine whether retained earnings, tax deferral, and long-term planning opportunities are possible. As tax advisors, we must first understand the client's lifestyle requirements before we can evaluate the true benefits of incorporation and compensation planning. One of the most common mistakes in owner-manager tax planning is failing to match compensation with actual cash withdrawals. When this happens, a shareholder loan can quietly grow in the background and eventually become a serious tax problem. Let's start with the example on the left side of the slide. Here, the owner's lifestyle requires $75,000 per year. The corporation pays $75,000 as salary or dividends, and the same $75,000 is reported for tax purposes. Everything matches. The cash taken out of the corporation is properly accounted for, properly taxed, and properly documented. This is good planning. There is no shareholder loan balance and no hidden tax issue waiting to surface in the future. Now look at the example on the right side. The owner still needs $75,000 to support their lifestyle. However, only $50,000 of compensation is recorded and reported. Despite this, the owner actually withdraws $75,000 from the corporation. That creates a $25,000 gap. The extra $25,000 has left the corporation, but it has not been properly characterized as salary, dividends, or another taxable form of compensation. Instead, it often ends up being recorded as a shareholder loan. At first, this may not seem like a major issue, but over time, these balances can grow. As shown in the center of the slide, a $25,000 loan in year 1 can become $50,000 in year 2, $75,000 in year 3, and over $100,000 after several years. As the balance grows, so does the risk. Eventually, the CRA may start asking questions. Why wasn't this money taxed? Why is there a growing shareholder loan? Why was income not properly reported? These questions can lead to reassessments, penalties, interest charges, and increased scrutiny of both the shareholder and the corporation. The lesson here is very important. Compensation planning must reflect reality. If a client needs $75,000 to live, then the compensation strategy must properly account for $75,000 being withdrawn from the corporation. The key takeaway is simple. Every dollar that leaves the corporation must eventually be treated and taxed as salary, bonus, dividend, or another legitimate form of income. Ignoring that reality today often creates much larger problems tomorrow. Good tax planning is not about postponing the issue. It is about ensuring that withdrawals, compensation, and tax reporting all stay aligned from the beginning.